freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and here's a very, very festive Adam Penn. Hi, Adam.
St. Patrick's Day. It's my second favorite holiday.
It is St. Patrick's Day when we're recording this. What's your first favorite?
4th of July.
Okay. So 4th of July and then St. Patrick's Day. I got you.
Yep.
Well, you've definitely dressed for the occasion. I at least wore green.
Yep.
Are you do you have plans for later today?
Yeah, normally I don't do any work on St. Patrick's. Like when I was a W-2, I took it off. Like even when I got hired, I'd be like, I don't work St. Patrick's Day. And they'd be like, what? I'd be like, I just want you to know I don't work St. Patrick's Day.
So you would just take the whole day off and just start drinking in the morning and through noon? And
I would never drink at time, but it would be, we'd do whiskey tastings, or we'd like cook corned beef when we would go around to the bars. And it was always a fun holiday.
Yeah,
I mean, then I graduate high school.
Well, I guess that's all right. So what are you doing today? You didn't really answer that. You have plans? Are you celebrating, or are you just wearing a festive shirt all day long?
I'm gonna celebrate. I'm gonna go get some Guinness in a minute. I'm actually not drinking for like 12 weeks right now, but I'm gonna. This is an exception. It's St. Patrick's Day, so I'm gonna go get a Guinness, and I think me and Kelsey are gonna go out tonight. We're gonna go have a cocktail or two somewhere. Get some shamrocks on us and get going.
No, that sounds like an excellent St. Patrick's Day.
I normally do a whiskey tasting at my house, and I think with the Tulsa site visit we did last week, it just kind of skipped my mind. I normally like brine my own corned beef. And The other day, Kelsey was like, are you going to do that? And I was like, yeah. She's like, it's on Tuesday. I was like, nope, takes a week.
That's all right. You had more important things to take care of.
Yep, like oil wells.
But speaking of indecipherable terms, like Irish words, true Irish, not like they speak English. I'm aware of that. But
like Gaelic, like Dún ní bhéal agus na bheacaint, which means shut your mouth and don't be talking in Gaelic.
I don't want to know how you know that. That's impressive. I don't know a lick of it. But indecipherable terms is a good segue into today's topic, because this is a No Investor Left Behind episode on I think one of our favorite terms. Not really, but a very common term, the debt service coverage ratio. Oh man, everybody get excited. We're talking about math and debt and all sorts of things. But no, this is a DSCR. You'll see this typically written, a very, very important term in commercial real estate. And I think it's important for a lot of investors to know and understand, especially if you are looking at investing in a deal, particularly a real estate deal. It's a very important thing to know, important question to ask if it's not something that's included in the promotional docs for the deal you're going to invest in.
Well, there's also before let's dive into what the term is, but there's also like DSCR type loans on single family homes.
True. Yeah, you're not going to be getting into those unless you're an investor, right? Most of the time, you're not going to run into that as a typical residential conforming mortgage. You're not going to run into this term too much. Let's talk about it, Adam. Yes, I would. Do you have any thoughts on DSCR? Do you want to try to explain it?
I want you to explain it to me. I want to go word by word. What is debt?
Okay.
In this case, what is the debt, right? Because it's not talking about the loan amount. I'm being serious here. Like it's talking about the payment, right?
It's true.
Like the debt service.
Well, the debt service, right? Like let's put those two together, right? So the payment amount. So this would be principal and interest, right? Which is the debt service. The cost is going to cost what it's going to cost you to service the debt. Possible for a interest only loan. This could be calculated as the interest only amount. Maybe getting a little too complicated for this, but for simple explanation, just think about it as we're talking about debt service. That's the mortgage payment, right? Principal and interest mortgage payment that's going to the bank. The coverage ratio is effectively how much from the income or how much income that the property makes. So this is, again, typically going to be on income-producing property, not on a residential mortgage. But for the amount of income the property produces, it's effectively a multiple, or it's a ratio of that amount to the debt service amount. So the actual math here is you would take the income, the net operating income, and you would divide it by the debt service. And you could do that monthly. Typically, you do it annually.
So if you brought in $20,000 a year of income, of net income, right? So back to our NOI episode, it's net income. It's not just the gross income. So after all your bills and taxes and everything's paid before you hit debt service, you have $20,000 of net operating income. You take that and divide it by, let's say you had $10,000 a year of debt payments, like $833 a month, you will be at a 2.0 debt service coverage ratio, meaning you make twice as much as your debt.
Yep. So that's the other way to think about it, is for basically every dollar that you owe to the bank in principal and interest, so on the payment, how many dollars of net operating income do you have available to cover that? And so in Adam's example, you would have 2. Right? So you end up with an extra dollar left over after that's taken care of. But that would be a 2x DSCR. And that's usually how it's represented, is like 1.25, 1.3, 1.5. That's how you would see this, not as a percentage, but usually as a multiple. So 1.25x is
well, and it's kind of a way the banks will look at the risk, right? Because if you were at a 1.0, it means that you couldn't spend another dollar and still be able to service their debt.
Correct. Yeah, that's and then if you go below 1, that means that the property is not producing enough income to service the debt, much less its own expenses, right? Like that's I guess after it's net operating income is after expenses, but then now you're having to come out of the sponsor, you as the investor, whoever is now having to come out of their own pocket to actually service the debt. The property is no longer fully covering the debt payments.
So when you see a deal that you're looking at and it's got a debt service coverage ratio of, let's say, 0.9, what do you do to fix that?
Well, as a passive investor, I don't know that I would be investing in that deal.
But as a sponsor, or as what are the things that can change that could improve that?
The biggest lever is obviously doing things to increase income, right? Because the debt payment is usually going to be fixed. Now, if you got floating rate interest,
or put more money down.
Potentially, yeah. So that's the other lever. But I guess I'm approaching it as from the point at like once you know the payment amount, like what can you do? But yes, you could do things to change the payment amount. Absolutely.
I think I'm thinking about it more on like, even if a deal has a good DSCR to begin with, but then they refinance, right? I mean, the lenders are going to look at these things, but it's basically the deal's ability to perform and not go underwater, right? Like distributions can get paused. No one wants to do it, but like that's distributions being paused is different than the bank saying you no longer own the property.
Yeah, correct.
And so, like we've got that building in Chico, NOI of about $8,000 a month, $7,000 a month, and debt service of 5-ish. I think
8 divided by 5?
No, our NOI is 12. There we go. I was like, we make way more money than that. Our NOI is 12 and our debt service is like 6. So it's like a 2.0. So that means that we could lose half of our NOI and still be able to make the payments. So there's a good buffer in there for the investors. Or it also means that we could double our debt service. Let's say it went floating rate, or we did a bigger cash out loan and still be profitable.
It's a measure of risk associated with the deal. I think it's one of the many. I think it's just to sort of talk about this from the passive investor standpoint. If you've never had to deal with this, so most lenders are going to require a minimum of 1.2, 1.25, somewhere in that. Now that can vary, but that's usually going to be the minimum. So it would be very difficult for you as a passive investor to even see a deal that had something less than that. If you did, it's definitely worth asking the question of who's providing the debt on this, because it's probably not a bank. It's probably not some sort of standard financial institution. But it's important to know that debt. Yeah, for sure. Well, 1 point whatever, sort of anything over the 1 is effectively the cushion, right? And to Adam's example, it's how much could the NOI decrease before you're not able to service the mortgage payment. And so you obviously want there to be a cushion, but too much of a cushion it's not a bad thing, but it might represent that there's some money being left on the table. There's a potential to, as Adam said, lever up and take more money out or use less equity to do the acquisition, and the returns, the investor returns could be higher. So it's a balancing game. But what you don't want is something that's super, super thin. And then I think especially if the DSCR is right at the edge, right, like a 1.2, and then there's a lot of other aggressive assumptions elsewhere that rely on those assumptions being met in order for that to either that cushion to grow or to at least maintain. You definitely don't want to invest in something that was already marginal, and then it starts getting down to the point to where the debt, the sponsor can't service the debt. Because then you, as Adam mentioned, you end up investor distributions are paused, or worst case scenario, the lender calls the loan due, or they decide they're taking the property back, they foreclose on it. There's a lot of bad things that can happen when DSCR starts dropping too low. So it's a very, very important thing to look at for, again, it's a proxy for the risk of the deal. I don't know. Yeah, I've got a couple other things to hit. I think you've already kind of done. So you mentioned, Adam, like how DSCR can change over time, right? You can start, and I think typically this is what would happen, right? You might start, a deal might have an initial DSCR of let's say a 1.3. If it's fixed rate debt and, a fixed term or something like that, the mortgage payment stays the same, but you have the ability to, through either operational improvements, value add, or just naturally incurring inflation where rents go up, the NOI will grow. And so that means that the DSCR will grow as well, right? Because you're starting, the payments are fixed, and then you already had a buffer, and that buffer just continues to get higher.
Assuming you don't mess it all up.
Correct. So it can go the other way, right? And there's a lot of that has happened in the last few years, and it's going on right now, where the income has decreased because of either mismanaged assumptions that didn't play out, expenses that got out of hand. The insurance quote or the insurance renewal comes back and it's way too high, so it can just as easily go in the opposite direction. So it's not this sort of fixed thing. You would expect this to move as the life of the deal progresses. It's just hopefully the buffer is increasing and not decreasing. So the other thing that's somewhat related to this is the idea of break even occupancy, because it factors into this. And that's, I don't know if we could dedicate an entire episode to that or not, but it's basically the idea, and again, this is usually in real estate, right? So self-storage or anything where you've got units that are going to be rented. The idea is how many of those need to be rented in order for you to maintain a 1.0 DSCR. And so that's, pay all the bills, pay the debt. There's no money left over, right? So there's no investor distributions happening. This is just purely like, we're going to break even and make sure that we're not going to lose the property. How many units need to be rented? And so that's known as break-even occupancy. So again, ideally, that's a number that is a little bit lower. You don't want that to be like 90%, right? Because now, 10-unit building, you got one unit vacant, and all of a sudden, you're there. So ideally, you want the break-even occupancy to be fairly low, to the point where you can absorb some vacancies or other issues might happen, or heaven forbid, there's a fire in a unit, something that causes there to be vacancy. There's the ability to absorb that without the DSCR compressing to the point to where you can no longer service the debt. I think that's about it. This
pretty
is
simple topic.
It is simple once you understand it, but it's one of those terms that I think if you when you come in new to the space or have never seen it before, it can be confusing in understanding how it works. But again, you can think of it as just a margin of safety, right? It's like a deal if you've got a 1.3 DSCR and a 65% break-even occupancy. There's a lot to pad that deal to where there's a whole lot of things would have to go wrong in order for the sponsor to be upside down in that and not be able to service the debt just from the income of the deal. I think that's about it. Always look at that. If it's something that's not in, and not saying that sponsors try to hide this, but I don't know that this is a thing that's always in a lot of like the high level pitch material, right? You may see this, you may not. So definitely worth asking if you're evaluating a deal. It's worth asking the sponsor for what the going in DSCR is, and then maybe how they expect that to change over the life of the deal. That's one of the in our underwriting model, we've got it per year what we expect the DSCR to be, and kind of model out those changes as income hopefully increases and we refi and potentially then bring that up a little bit more. So there's a lot of things. It's a moving data point over the life of the deal. But any sponsor that avoids a question around that, that's kind of a red flag. And then if you're seeing it and it's, again, break-even occupancy at 80% and you got a 1.2 DSCR, not a lot of room for stuff to go wrong in that deal before really basically almost anything goes wrong and your distributions are going to get paused because there's not going to be any money left over. And then not much room before the lender's knocking on the door of the sponsor wanting to talk about taking the building back, which is never a situation any of us want to be in. Any final thoughts, Adam? Closing thoughts?
I don't think so. I mean, I think it's just another metric, right? Understanding what it is.
For sure. All right. Well, we'll keep this one short and sweet. Appreciate everybody listening. If you have enjoyed this, as always, go like and subscribe on YouTube. Give us a 5-star rating on Apple Podcasts and do whatever in the world it is you do on Spotify. I have no idea. But let the computers know that you're enjoying what you're hearing, you're learning from it, and we'll help get the message out to more people. But we appreciate you being here. Thanks so much. We'll catch you on the next episode. Just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.